let's go straight into the point, because now is the time wherein people want to know more about property, because despite this very special time, they still want to buy property, sell property. And one of the most important things is property taxes here in Cambodia. So with your experience, can you tell us more about what is the property tax in Cambodia, how is it defined, and why is it important?
Okay, well, property taxes came in at different points in time in Cambodia. The history is the Khmer Rouge actually did away with property ownership. So property records were destroyed, and the country has gradually recovered in all establishing property laws and establishing property titles and so forth. But one of the key legislations in the country was the tax on immovable property, which came into effect with the Law of Financial Management in 2010. So it was effective. The Law of Financial Management typically comes in effect in the next following year, so 2011. It comes out in December or November, and then it eventually gets implemented the next year. So the key part of that was actually to have a property tax. So that means somebody that holds property, immovable property, is taxed annually. So it's a recurrent tax, which is very important to the country to have these taxes. Property tax is always an important tax globally for countries in terms of tax collection. It usually comprises about 3% of GDP. So it's a very important means of collection in countries, and usually used for social causes or educational causes in some countries. But in Cambodia, since it's pretty much a new tax, that it only came in effect in 2011, it's only 0.1% of GDP, which means it's pretty low. It's pretty low, and it also means that there isn't a broad collection of it. So it has historically been implemented and enforced in the bigger cities, but not so much in the provinces.
Are there other taxes that they should take note of?
Right, so the first tax, if you're becoming an aspiring property owner, is the transfer tax, which is 4% of the sales value. Now, again, historically, that's been, I would say, underreported in transactions, and is actually a bit lower, but it should be 4% of the transfer. Normally, the purchaser pays that. The purchaser pays that, but that's negotiable, and as is any transaction where you're doing a buy or sell. But that 4% tax, that's pretty high when you're doing a property. So if you're doing a property for $200,000 or $300,000, you're talking then about $8,000 or $12,000. So that's quite a significant.
It is.
But again, it's that 4%. There's an immovable properties assessment committee that determines the values of these properties. So the tax department has the right, if you're underreporting, to ask you to assess a higher value. Well before the other taxes. So the unused basically is if you have, I would say, non-agricultural land, where you have you're not using it at all. Then you would have to pay a 2% tax on the value of that land. And that would include abandoned buildings as well.
Who determines the value of these?
This is an immovable property assessment committee, as far as I know, it does that. So it's not some tax that I'm actually seen widely applied, as opposed to the property tax and the transfer tax, but it's out there. I think the important, very important, relevant thing that happened is that there was a definition of individuals now included in the taxation system. So without getting into tremendous detail, that's individuals are effectively taxed.
Yeah.
So businesses were always taxed on capital gains. So if they sold and bought property as part of the business, it was absolutely taxed. As an asset disposal, it was taxed at the tax rate 20%. The capital gains tax rate. So this is nothing new to businesses. So I want to make that clear. People misunderstand that this is a capital gains tax that's new to everybody, but it's not. Businesses have always been taxed.
Okay.
The law is effectively changed now to consider individuals, which this is the material change. So there's a Procus 346, in case people are interested, if they want to look it up. It was April 1st, 2020. The original intent, I say original intent, was to do it in July of last year. Then there was a delay till what was supposed to be January of this year. And given COVID and probably a little bit of lobbying by the real estate community and property owners of high value,
Okay.
I would guess. Not to say, I mean, it wasn't for selfish reasons. I think there was concern about the property market perhaps being materially impacted.
Capital gains is coming, so I think it's important for everybody really to know how is it calculated.
Okay, there are two methods to calculate the capital gains tax. One is called the actual expense deduction method.
Okay.
With the actual expense deduction method, you basically take the sales proceeds and you can subtract expenses from that. And those expenses can be obviously the purchase cost, what you paid for the property, and you could add things like consulting fees, registration tax, any commissions you might have paid to sell the property, evaluation fees if you had an evaluation done, loan fees, interest expense, even advertising or renovation expenses. So that's your actual expenses. Your actual expenses are deducted from the sale proceeds, and you take 20% of that and you get your capital gain. The determination-based expense deduction method is a mouthful, but it's basically a lot easier, and it's quite a generous method. It's basically you take your sales proceeds and then you take 80% of the sales proceeds and subtract it from the sales proceeds, and that's your capital gain. Now, you could think the people that had property for 20 years, they might have paid a very small price. They might have paid $10,000 for the property, and it's now worth $1 million. So if you would have had a huge capital gain in that case, but now you can take 80% of the $1 million and subtract it, and that's only $200,000 capital gain. It really works out for people that have held property a very long time that's grown. So instead of just taking a huge gain on the basis of what you're actually paid for it, which would probably be very low, anywhere from 5 to 10 or 20 years ago, it would be extremely low. You take 80% of the sales proceeds and subtract it from
I see.
as your expense base, and then pay only 20% on that.
You mentioned two methods to calculate it. So how does one determine which one applies?
The cheapest one.
Cheap?